Hey everybody, thank you for coming to hear me talk about some of my ideas. I'm really excited to share them. Today I'm going to be talking about how traditional finance might turn into legacy finance, and just some caveats off the top. There's a couple reasons to just like, this talk's going to be kind of about what could happen and what could happen on a long time horizon. Last week, I kind of gave a talk that talks about a lot of the risks and like why that might not happen and like how the community needs to come together to address those things. And if you want to see that to kind of temper maybe some of the possibilities in this talk, I pinned that to the top of my Twitter profile, which is Scott_LEW_IS. And the other caveat is that, this isn't stuff that's going to happen in the next week, month, 12 months, year. It's really kind of at scale, and we're going to get there. If we get there, it'll be because we get there. We're going to get there in time. And so with that all said, first want to talk about how liquidity exists and how customers, when they come to the market and they have something they want to trade. And when I talk about customers, we talk about someone that's using the market to transform their risk portfolio. It's not someone that's using the market to try to make a lot of trades to make money. I consider those more, for this talk, I'm going to talk about them as market makers, but that's really like market makers, high frequency traders, quants. But customers are just people that are using the market for what it's kind of supposed to be used for. And then on the other side of the market, that's the liquidity. We have market makers whose kind of job is to balance order flow and to adjust the price so that kind of the buyers and the sellers roughly equal out. And so let's think about how like markets grow. And to do that, I'm going to share my first slide. So it comes from competition to trade against customers. And if we start off with the market and we have one market maker or a specialist, they might start making market in that product because there's a few people that really need that product. And so let's say they have two customers. Those customers are going to get a pretty wide spread because that one market maker is going to be charging monopolist prices. And so the market will probably be really liquid, high transaction costs. But if our customers that really need that product, that might attract more market makers, more liquidity. And so let's think about a second market maker joining that market. Now the spreads are going to tighten because rather than the one market maker being a monopolist, they'll now be duopolist pricing, and that pricing will be more competitive. And when that pricing, those transaction costs go down, that would attract more customers because there may be more people that wanted to trade the market but didn't trade because the costs were too high. And as kind of that bigger group comes into the market, that will probably attract even more market makers to kind of compete and to split up that customer order flow. And kind of that pricing for how much it costs to transact goes from monopolist pricing to duopolist pricing to oligopolist pricing to just kind of like something that's more of a wide open competition. And when you get wide open competition and kind of this market matures, a lot more customers can be attracted because the cost of trading go down quite a bit. And that you can think about that as kind of a liquidity flywheel, which is interesting. But like another thing that's maybe a little more interesting is, where does it stop? And it stops when kind of the market hits its total addressable market for that structure. Prices kind of get as good as they might get, and the market matures. And so this is when how liquidity works starts to matter, because the structure of the market is going to affect where that point in time stops. And I want to take a look at a kind of a fun market called the Minneapolis Grain Exchange. Here's their website. They trade North American hard red spring wheat. You can see kind of, I think the design of the website, it kind of reflects the excitement of the market. It's pretty sleepy. It trades kind of the third most popular wheat future in the world. It's a very kind of back and away market. It's not terribly easy to trade in this market, whether you're a market maker or a customer. And the structure of the market kind of keeps people out. It turns it into a silo. And like, I can't trade on the market today. If you wanted to, it'd probably be hard. If you worked at kind of a traditional bank that wasn't like a commodities industry player, might be too expensive for your firm to get involved in that market. And a lot of people are kind of kept out of the market because it is siloed. But kind of the key question is like, what happens when there's this siloing? It keeps the amount of smart people that can look at the market and can speculate on it and speculate whether there will be a wheat shortage goes down. And kind of smaller markets with limited participants, the wisdom of the crowd isn't quite as wise, and it's harder to balance flow. And in 2008, there wasn't enough. There was serious fears there wouldn't be enough wheat, and the price on the Minneapolis Grain Exchange went crazy. Essentially, a supply of a failure in the underlying market, and this kind of dragged up the other Kansas City wheat, Chicago wheat too with it during this time period. But it was caused because of the siloing of liquidity. And this is kind of where we get the first idea of how DeFi is a bit different, because DeFi de-silos markets from each other. And it does that because you have like one universal financial login, which is your Ethereum address. And if a DeFi protocol wants to keep people out of the market, they actually have a lot higher costs to do that. And everything is natively open. But in traditional finance, sort of like the Minneapolis Grain Exchange, everything is natively closed. Because the Minneapolis Grain Exchange can't just let anyone log in with Google and start trading, because they have to do all of these other checks. Because if you just buy a bunch of wheat futures, you may not have the money to actually collateralize those wheat futures. And so there's a lot of stuff that has to happen that's very expensive for a small exchange like the Minneapolis Grain Exchange to do. And one of the things that I hope happens is that in the future with DeFi, all of these products can be traded by anyone that wants to trade them, and these barriers can come down. And these sort of sleepy silos will be less important. Will be not less important, will not actually be silos. But then let's shift a little bit to talk about a different type of silo, one that's maybe not sleepy, but is instead dark. And for that, I think a good example of that is auction rate securities. This was kind of a niche market, but an enormous market. I think the market was 200 billion in size, and it was very hard to get involved in this market. It was an interbank market. There's little transparency, and this first kind of became a bit more known in 2006. The SEC basically found a large portion of the market was involved in some very bad practices, and these 15 firms had to pay a somewhat paltry amount of $13 million. And this included violations like intervening in auctions by bidding from a firm's proprietary trading account and then asking customers to make or change their orders. The reason they were doing this was to prevent failed auctions, because if the auction fails, the real customers realize the market has serious problems. They probably won't want to interact with it. They did other stuff, like they had express or tacit understandings to provide certain customers with higher returns than the auction clearing rate. And essentially what the SEC found in this like very large settlement as far as number of participants, even though the financial penalty was not that high, was that like this market sort of somewhere on the spectrum of like being rigged, and being rigged in a way that was designed to make the customers of the market think the market was very healthy, when it actually was not. And so the SEC did their enforcement action. Great, problem solved, maybe. So then things just kept going as they were going. And an astute observer might wonder if it wasn't actually the bad behavior of these 15 different firms, but actually some problems with the underlying market structure. And what happens if the people participating in this market actually say, hey, this $200 billion product is actually pretty broken and maybe we shouldn't be doing this. Well, you're probably not going to be an auction rate securities dealer anymore. And if you spent your career building up customer relationships in this space, and that's kind of your only real long-term expertise, you're kind of in a really tight spot. And it kind of turns out that like when these bankers were in that position, they kind of finagled it. And even after getting caught, that didn't really seem to change that much, because 2 years after 2006, the financial crisis hit. And what happened when the financial crisis hit? Things actually got much, much worse. The auction rate securities market collapsed. And the people that had their money in this market did very poorly. And they weren't able to these auctions that were supposed to be very liquid and safe did not exist anymore, because the banks that had been supporting them were in dire straits from the financial crisis. This led to more regulatory action that was much, much, much bigger than before. UBS had to buy back 18.6 billion in securities, finding that they used profoundly deceptive sales practices. While they were telling their clients these securities were safe and liquid, they actually kept the purchasers in the dark to sell the clients their inventory. Merrill Lynch, which had to become part of Bank of America during the financial crisis, actually stopped their own analysts from reporting the truth about this market, and instead published a report telling them it was time to buy. And then Citigroup, 7.3 billion in repurchases. They actually got caught destroying evidence related to the probe. So we don't know what their deceptive sales practices were exactly, but it probably wasn't that good. And the question is, like, why should the financial system exist in these small silos? Like, why is it good for humans to rely on a financial system that is so closed off, and where the only people that know how the market is operating is the people whose livelihoods depend on people thinking the market is operating perfectly well? I don't think that's a good situation. And I think as long as we have these hidden silos, where in the financial system, where finance is happening, we're sort of always going to be waiting for the next crisis to come and hurt people. And one of my hopes for DeFi in fixing this is that by de-siloing the liquidity and kind of making transparency the default setting, it's sort of just, it shines a light on everything. And like the chicanery in these auction rate security auctions it couldn't happen in like an open, transparent DeFi protocol, because everything that happens on the auction is visible to all participants in real time. And everyone can make a decision whether they would like to participate in the auction, and they can evaluate whether that auction is an economically meaningful, or like whether the auction makes sense to participate. And if the auction is completely toxic, and everyone can make that judgment, I doubt it will be easy for people, for salespeople in these markets to sell these toxic products to their customers, because it'll be so easy to find out the truth about the health of these markets. And even though DeFi is just right now not nearly big enough to support any of these markets or solve any of these problems, there is hope that if DeFi can avoid a lot of the risks and avoid falling off the rails, that this liquidity flywheel and this like one unified market for liquidity can create a bigger flywheel with a bigger total addressable market, and de-silo the financial system and create something that's safer for humans. And I think that's something that's worth spending your time building. But anywho, yeah, well, yeah, thanks for listening.